everyone. Today we're going to be looking at one of the most important building blocks in tax, and that is gross income. Understanding what is included in gross income and also what is not included in gross income is the first step in figuring out your tax liability. The U.S. tax system starts with the presumption that everything is taxable unless there's a very specific rule saying it's not. So we want to figure out what are those rules and apply them correctly because we want the lowest tax liability possible. So let's just first start off with what is gross income. Let's begin with the IRS definition. So Section 61 of the Internal Revenue Code defines gross income as, and I quote, all income from whatever source derived, unquote. That is very broad, and it's supposed to be. Basically, it includes compensation for services, business income, gains from property, interest, rents, royalties, dividends, alimony, if the divorce was before 2019, annuities, pensions, discharge of indebtedness, and more. Pretty much, if you can think of it, it is most likely income. So the tax system assumes that if you receive something of value, whether it's cash, property, or services, you likely have income. Even if you barter services, those are considered income. For example, if a personal trainer trades services with a massage therapist, each of them must include the fair market value of the service received in gross income. So let's take a look at some common taxable income items. Most taxpayers are going to be familiar with these that need to be reported, such as wages and salaries. This includes your tips, bonuses, and any fringe benefits unless they're specifically included. What's a fringe benefit? That is an additional incentive or perk provided to employees beyond their regular salary. So here's some common examples: paid time off, health insurance, or maybe even a company provided phone or laptop. Then you have self-employment income. If you run a side hustle or you do some freelancing, you must report that income on Schedule C. Even payments made through Venmo or PayPal are going to count, any income that you receive. And then unemployment compensation. So during COVID-19 relief years, this was tax-free, but that was just a temporary thing. Generally, unemployment compensation is taxable. And then there's interest and dividends, savings account interest, bond interest, except if it's municipal, that is one of the exceptions, and stock dividends are all taxable. Your rental income, short-term rentals like Airbnb, all of that needs to be reported. So basically, if you receive a 1099, the IRS already knows about the income and they're going to be looking for it, and if they don't find it, you might receive a letter or maybe even an audit. All right, let's look at some common non-taxable income items. So while most everything is going to be gross income, not everything you receive is taxable. There are exceptions, specific exceptions. So some key examples are going to include gifts and inheritances. Those are generally not taxable to the recipient. Now, gifts and estate law is a very complex law, so you're going to want to check in with your own tax consultant on that. But it might be taxable to the giver or the estate, but generally, even if it's a large sum of money, not taxable to you as the recipient. Now, if you sell it or other things, there's other rules, but generally not taxable. Life insurance proceeds, those are not taxed if received as a death benefit. Municipal bond interest, federally, that's tax-free. States may tax it though. Child support payments, that's not going to be taxable to the recipient, nor is it going to be a tax deduction to the person who paid it. And then you have workers' compensation. So that would be excluded if received for work-related injury or illness. Now, there are caveats to everything. So context matters. So back to that inheritance, if you sell inherited property, that could trigger capital gains rates. So it is always very important to talk to your own tax accountant that knows your specific situation. All right, now let's talk about some gray areas and exceptions. Unfortunately, not everything just falls into a yes, it's taxable or no, it's not category. Some of them are going to require judgment. So scholarships and fellowships. These are tax-free only if used for tuition, fees, and required materials. If you're going to use a scholarship for room and board, then that scholarship may be taxable. Legal settlements. So if you have been physically injured, that award will be non-taxable. But if your legal settlement is for emotional distress or punitive damages, that would be taxable. Employer provided benefits. So we already talked a little bit about those fringe benefits. If you have an employer paid health insurance, that's excluded. But some perks, like a gym membership, perhaps, if it's something that's being paid for, not and it's not in a wellness plan, that could be taxable to you. Debt forgiveness, so generally that would be taxable, like if you had a credit card that was forgiven. So those type of things are taxable unless you qualify for a special exception, such as insolvency or bankruptcy. So really you're going to want to ask detailed questions, document your facts, and bring that to your tax preparer. All right, so once you've determined what income is taxable, it needs to be reported. And some common forms that you're going to see for this might be a W-2. So if you're an employee, you're going to receive that. If you're a contractor, you might receive a 1099 NEC or a 1099K if it was being reported as credit cards. You might have 1099 interest, or so 1099 INT. A 1099 div would be where dividends are reported. And then your Schedule E is rental and other income. All right, so the IRS, again, they use automated systems to match what was reported to them against what you filed. So if you receive any official tax 1099 or K-1 documents, the IRS also has a copy of that. So if you have a mismatch in what they've been reported and then what you've received, that could trigger letters or even audits again. So the bottom line here is if you receive income, you should report it unless there is a clear exception. And as always, for any questions, go ahead and consult your tax advisor.